Most people don't get screwed on taxes because they don't make money. They get screwed because no one explains how these rules actually work together. Today, I'm going to break down step up in basis, a 1031 exchange, and DSTs, that's deferred sales trust in real life terms, using examples I actually see with clients. If you own real estate, inherited property, or you're thinking about selling something big, this is one of those videos you want to understand before you make a move. And if at any point you want help applying this to your situation, click the link below the description and get clarity before you sell or move money. Part 1, step up in basis. Let's start with step up in basis, because this one applies to a lot more people than they realize. Imagine your grandmother bought a house back in 1959 for $5,000. Back then, some areas were literally orange groves. Fast forward to today, the same property might be worth $900,000 or more. Now, here's the key part. When the property is inherited, you did not choose to buy it. You didn't cause the appreciation. You didn't benefit from the inflation. So the IRS treats this differently with step up in basis. With step up in basis, the tax basis resets the value of the property at the time of the original purchase date. That means you are not taxed on decades of appreciation. You're only taxed on the gain after you inherit it if you sell. This is huge for families in areas like Arcadia, Baldwin Park, Monrovia, Claremont. A lot of these homes are legacy properties passed down from grandparents who bought early. That's why people in those areas are able to sell inherited homes without massive capital gain taxes. That's step up in basis. If you're sitting on an inherited property and unsure how this applies, click the link below in the description before you sell. 1031 exchange. Now let's shift gears to 1031 exchanges, because this is where people get confused. A 1031 exchange only applies to income property, rentals, multi-units, commercial buildings, not your primary residence. Here's how it works in real life. Let's say I own a 4-unit rental in Pomona. Over the years, I've collected rent, used depreciation to offset my taxes. The government was cool with that while I owned it. But the moment I said, I'm gonna sell it, cool. Now we want that depreciation back. That's called depreciation recapture. So what do I do if I don't want to pay the tax right now? I use a 1031 exchange. With a 1031 exchange, I sell the income property. The money never touches my bank account. Escrow holds the funds. I reinvest it into another like-kind income property. That allows me to defer capital gains, deferring the recapture of the depreciation, upgrade into better property, scale units, or move into commercial real estate. Important rules: you have 45 days to identify replacement property. You have 180 days to close. The money cannot sit in your personal bank account. The 1031 is great if you still want to be active. Want more or better real estate? Know exactly what you're buying next. If you're selling an income property and unsure whether a 1031 makes sense, click the link below in the description before escrow closes. Let's discuss DSTs, the Deferred Sales Trust. What is it exactly? Let me tell you. With a deferred sales trust, when you sell income property, it could be any type of property that you actually have passive income over, units, complexes, and whatnot. When you sell that property, the government wants to recapture the depreciation that you took to be able to avoid taxes as you own the property. Now, you decide to sell the property. The government's like, cool, not a problem. We want that tax break back. Fine. How can you avoid that? Not a problem. Here's the solution. You put it into a deferred sales trust. The money that's gained from that sale of property goes into the DST. In that DST, the money will sit there 100% tax-free, so long as you don't use it, so long as it doesn't hit your bank account. Now, in that trust account, you are able to invest it. That money will be invested, and the money that you accrue on the initial investment is completely 100% tax-free. You are able to take loans over it, and you are able to make distributions. Now, let's talk distributions when it comes to a DST. When it comes to a DST and you distribute money, you only pay capital gains on the amount of distribution. So for example, I want to buy a new car. and I want to pay it cash. And I'm sitting on $900,000 in the sale of my passive income property, but I need $50,000 to be able to purchase my new vehicle. So I take $50,000 out, I pay for my vehicle, and I only pay capital gains on that $50,000 that I take out. I deferred 100% of the taxes for the entire amount of the capital gains. But as I distribute it for personal use, I will have to pay taxes over it, just the amount that's being distributed. Real example, let's say I decide to sell one of my 4-unit properties out in Pomona. After paying off the loans, I walk away with $900,000 in equity. If I cash out, massive tax bill, right? Instead, I move that $900,000 into the deferred sales trust. Now, the full $900,000 is preserved. It gets invested. The growth inside the trust is tax deferred. I don't owe capital gains until I pull the money out. This is the key difference with a 1031 exchange. You must reinvest into another property, right? On a strict timeline. With the DSP, you buy time. You gain flexibility. You decide when and how much tax to trigger. Let's say later I need $20,000 for my daughter's wedding or business opportunity. I pull out $20,000. I only pay capital gains tax on that $20,000 and not the full $900,000. That is powerful. If you're selling and unsure what your next move is, click the link in the description and get this mapped out properly. Here's where people really mess up. They sell, they cash out, they listen to the bank. They don't ask the appropriate questions. This is the same mistake people make with 401ks and IRA distributions. For example, you make $100,000 at work. That's your payroll. You pull $20,000 from your retirement account. You think you're just taxed on $20,000. Wrong. Your adjusted gross income is $120,000 if taxes weren't withheld correctly. You jumped tax brackets. You owe penalties, early distributions, you owe interest. And most bankers don't ask the right questions. You don't ask why you need the money. They just cut the check. That's how people get wrecked. Same thing happens with real estate sale. Then there's no planning before the escrow. How these strategies work? Here's the big takeaway. These are not competing strategies. Step up in basis, legacy and inheritance. 1031, active growth. DST, flexibility and timing. Smart planning isn't about avoiding taxes forever. It's about controlling when and how you pay them and how you can do that last minute. If you own income property, inherited property, or thinking about selling anything significant, do not guess. Click the link in the description and get clarity before you sell, exchange, or move money. The difference between planning and guessing can be hundreds of thousands of dollars.